Welcome to Quick Financials. From major economic trends to deep dives into the world's most interesting companies, we're here to break down the complex world of finance into simple, everyday language. Let's dive in. Imagine walking down the street and seeing a store offering the latest iPhone for just $150. Your first instinct is to rush in and buy it, right? But in the world of investing, a price that looks too good to be true is often a warning sign. This is what professionals call a value trap. Beginner investors often see a stock with a very low PE ratio and think they've found a bargain, only to watch the price drop another 50% after they buy. Today, I'm taking you behind the scenes of professional portfolio management to show you a three-step screening system that separates the winners from the traps. The first tool in our kit is the PE ratio, or price to earnings. It's the most famous metric in finance, the stock price divided by the annual profit per share. For example, if a stock costs $100 and earns $5 a year, its PE is 20. This tells you that at the current rate, it would take 20 years for the company to pay back your investment through its profits. But here's the critical catch. The PE ratio is a historical look. It's like driving a car while looking only at the rearview mirror. It tells you what happened last year, but it says nothing about the cliff that might be right in front of you. A company with a PE of 8 might look cheap, but if their industry is dying and their profits are about to crash, that cheap stock is actually a ticking time bomb. To avoid the rearview mirror problem, we need to look at the road ahead. This brings us to step 2, the PEG ratio. PEG stands for price to earnings to growth. It takes that PE ratio we just talked about and divides it by the company's expected growth rate over the next few years. This is a real game changer. Let's compare two companies. Company A has a PE of 15 and is growing at 5% a year. Company B has a PE of 30, double the price, but it's growing at 50% a year. If you only looked at the PE, you'd pick Company A every time. But the PEG ratio tells a different story. Company A has a PEG of 3, while Company B has a PEG of only 0.6. In the investing world, a PEG below 1 is often considered a massive buy signal. It means you are paying a very fair price or even a discount for a lot of future growth. By using PEG, you stop looking for cheap stocks and start looking for undervalued growth. This is how you find the next market leaders before everyone else realizes how fast they are actually expanding. Now we reach the most important step, the one that separates the amateurs from the pros, the cash test. There's an old saying on Wall Street, earnings are an opinion, but cash is a fact. Because of complex accounting rules, companies can report net profits that don't actually exist in their bank account. They can hide expenses, delay payments, or use one-time gains to make their reports look beautiful. But they cannot fake free cash flow. This is the actual cash left over after the company pays for its operations, its taxes, and its investments in growth. The price to free cash flow ratio, or PFCF, tells us how much we are paying for every dollar of real spendable cash the company generates. If a company shows rising profits on their reports, but their free cash flow is negative or shrinking, that is a massive red flag. It means the profit is just paper, and the company might be struggling to stay afloat behind the scenes. A truly great company is a cash machine. It generates so much excess cash that it can pay off debts, buy back shares, and pay you dividends without ever needing a loan from the bank. If a stock passes the PE and PEG tests but fails the cash test, you walk away. So, let's put it all together into your new professional filter. Before you ever hit the buy button, run the stock through these 3 questions. First, is the PE ratio reasonable compared to its history and its peers? Second, does the PEG ratio show that I'm getting a good deal on future growth? And third, is the free cash flow strong enough to prove the profits are real? When a stock passes all three, you aren't just gambling on a ticker symbol, you are investing with a strategy. At Quick Financials, we believe that the stock market shouldn't be a mystery. It should be a tool for building wealth through logic and data. If you found this guide helpful and want to see more professional deep dives into the world of finance, hit the like button and subscribe to join our community.